Hi everyone, welcome back to another episode of Providence Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Provident. So join with me today is a very special guest, Cheng Chai Sen, Providence Head of Investment. Hi Chai Sen, thank you for joining us today.
Hi Isaac, great to be here.
Right, so Chai Sen, while preparing for this podcast, I noticed that you joined Provident in 2013. So this year marks the 10th year that you are at Provident. So how have your decade-long journey been, and can I call you a veteran of Provident now?
Well, yeah, it has been about 10 years since I joined Provident. I remember it was late April 2013 and I joined, and after that the Fed hiked interest rates, or they stopped QE or something, and rates rose, and REITs fell. So that was a very interesting time to join. Experience. Well, it's been a long journey for the firm and how we invest. I think we've made great steps to being very clear on how we invest for our clients, and also I think the results sort of speak for themselves. In the last few years, it's been a lot more consistent and a lot clearer how we are trying to give our clients a good investment experience.
In 2013, you mentioned that REITs fell, but in 2018, we can see that we almost went into a bear, and 2020 was COVID. So how do you deal with all these things? You know, there's always something to be concerned about, and how do you feel knowing that, okay, so this year, I hope it's not as uncertain as the previous year, but then, you know, there's always something that comes up.
Yeah, I think that without that uncertainty, we wouldn't have the returns that we are expecting to get. Because if your return is certain, then it will not be so high. It's the very uncertainty of investing in businesses that makes investors demand a higher future return, so that they are compensated for the risk they take. It's all about risk and return. If you take no risk, then you cannot expect a very high return, because if a riskless investment gave a very high return, I mean, if you think about just simple supply and demand, everybody would buy that riskless investment. There'll be nobody investing in anything risky. But as more and more people chase that risk-free return, I mean, whoever is giving you that return isn't going to say, hey, I'm going to give you a high return in the future. They're going to bring the return down to a really, really low level, because everybody wants it. There's no reason for them to pay you a high return if everybody wants to give them capital. So, you know, if you think about it, that's just what market forces are, and that's market pricing. And sort of equilibrium theory. The market will sort of price goods, price investing appropriately, such that a high risk investment will give you a higher return. A low risk investment will give you a lower return.
Right. So today's topic is Provident's investment philosophy. So who better than you to share what this philosophy is and what underpins this philosophy? So let's begin with the 4 pillars to Provident's investment framework. So Chai Sen, what are these 4 pillars, and could you briefly describe each of them?
Yeah, so the 4 pillars are economic contribution, empirical evidence, implementation, and practical consideration. So going deeper into each one, first of all, economic contribution. I think so when we think about investing or an investment asset, there has to be an economic rationale for the return that you're getting. So for example, a simple one is stocks, right? What are stocks? They are an ownership stake in a company, right? If you own equity in a company, you really own part of that company. So if you own part of that company, if it does a business, whatever it is, selling goods and services, you would expect a return because
Right.
the company will operate and sell goods and services. However, if you invested in something that had no specific economic rationale for a return, say, I guess a recent example might be cryptocurrency, and I know there are a lot of crypto fans out there, but I mean this is just cryptocurrency doesn't really have an economic return. It's it's like a currency, right? Currencies technically don't really give you a economic return. They're more of a store of value.
Right.
So the I guess rise and fall in the value of cryptocurrency is less based on economic rationale, but basically demand and supply from people who are interested in buying and selling that cryptocurrency. So that would be something that probably wouldn't check that box on economic contribution. And the next one is empirical evidence. So I mean, that's just what it is on the label. Yeah,
long-term data. Yeah.
That's right. We just want to see that there is data around this investment strategy or asset or style that shows that there's some consistency for this return, that there's some long-term kind of consistency around the return. It's, you could have a great investment strategy or some kind of opportunity, but if there was no data around it to prove that this strategy or this investment style works, then it would be hard for us to also get extremely comfortable with it. So basically, empirical evidence means we just want to see some data around an investment opportunity and what it entails. Next step is implementation, where we look at how this can be implemented in our portfolios. Things that we think about is cost, accessibility, and whether or not the asset will fit into the portfolios well. So these are the implementation kind of considerations. But a big one definitely is cost effectiveness. Yeah, we try to make sure that however, whenever we're implementing something in the portfolio, it's not just about the cost of the fund or the investment instrument, but also trading costs, other kind of fees that a client might have to pay to access that. So we do consider costs quite heavily. And lastly, practical considerations is we understand that every client's experience is unique. Every client's position is different. So we try to take into account the client's unique circumstances when making recommendations or trying to craft an investment solution for the client.
Right. So going deeper onto this, you gave an example of crypto being a rejected instrument, and earlier in the podcast you mentioned that stocks, for example, is something that is accepted. So let's go deeper into that. So let's say we are analyzing crypto. So in the past 2 years, there's a lot of interest in, Provident, why don't you have crypto in your portfolios? Crypto has been doing really well. Are we, the clients will ask, like, are we missing out? So using this framework, you mentioned that, crypto don't really have economic contribution because it's essentially a currency. But, so what, in terms of an accepted instrument, like, why is stocks an accepted instrument then?
Yep, good question. So, like I mentioned earlier, for a few reasons, stocks are, there's an economic rationale for having a return on stocks. First of all, you are taking the risk of owning a business. So to invest in a business, you expect a certain return. I mean, you can just think about it simply like, say you open a cafe or a restaurant in Singapore and you're investing in that. Right? A stake in a restaurant, what does that mean? You get a share of the profits. You also take a burden of the losses as an equity holder. So if your restaurant made $10,000 a month net profit, if you were a 20% shareholder, you would be expecting, at least $2,000 a month in terms of your return every month, right, as a shareholder of the business. So it's the same owning a stake in any company through equity. you would expect a certain return from the business if it's profitable.
Right. So it's like behaviorally as well, like if let's say the value of crypto falls, like it has the past year, that's when people start to reach for reasons to hold, like, what's the intrinsic value of what I'm holding, Whereas if let's say you own a business, let's say you own McDonald's, right? And you see that let's say the share price has fallen, but when you go out there, you still see, McDonald's is still fundamentally still quite sound. So behaviorally, it's also a lot easier for you to hold on to your investment and tide through whatever volatility there might be.
Yeah, definitely you can think of it that way. I think that's a good way because I think one example that I've heard used previously is there was a manager and they were an advisor and they were meeting clients during the great financial crisis back in 2008, and clients were worried. I mean, that time, stocks were down 50%. But, they were sitting in a meeting room and just across the road was a Starbucks. And, every 5 minutes, they just saw people walking out of the Starbucks holding a cup of coffee. What does that mean? I mean, even though the stocks are down, but that business across the street, Starbucks, is still operating. And so that gives you there's a reason why there's a value to that business. I mean, the market can price in a lot of risk or short-term information, but if you look at it down to the fundamentals, when you are holding a stock, I mean that's what it entails. So I guess even recently, last year when there's been a lot of uncertainty in the market, I mean we're all still using lots of goods and services from various companies that we hold in our portfolios, which are very diversified. So that's one way we try to encourage clients that to help them understand that we are investing in businesses for the long term. And I guess for other reasons like stocks, as we are talking about, empirical evidence, if you look at stocks over the long term, there has been a positive expected return for holding stocks. I mean, the return on stocks is over time, on average, is higher than the return on holding cash, right? Holding 3-month T-bills or holding 6-month T-bills even. So, that shows you that, there is a equity premium, I guess you call it, from the data, and that you can expect a return that's higher by holding stocks because there is a risk involved, much riskier than holding a T-bill, right? So you definitely have to get a higher return for that over time. If not, there will be no investors in companies. Everybody will be 100% in T-bills if that weren't the case.
So we have, very stringent, we stick to this framework very stringently. So as of today, we have stocks and bonds in our portfolios. Is that something that can change in the future? Are we, open to more instruments in the future?
I think we are always considering what's out there. I mean, we definitely thought about things like crypto, especially when it was doing extremely well. We have also considered things like alternatives, things like private equity, hedge funds, etc. So we are always keeping an eye out for opportunities to improve our portfolios or to improve the client's investment experience. But I think in terms of something that we can put into our model portfolios comfortably, stocks and bonds still form the basis of it. And most of these other things that we have considered might really only be for unique cases, because we don't just consider just purely the investment return to the client, but we are first and foremost wealth advisors and planners. So we consider the client's needs and goals and circumstances also when we craft a solution for the client.
You mentioned that the client's needs. In investing terms, like need for return is something that really ties in with the philosophy of sufficiency. So in terms of investing, could you explain the concept of enough?
I guess having enough return for a client would be the return that can help the client achieve their life goals in the most, I guess, comfortable, stress-free manner.
Okay, so in the past few years, there's a lot of inquiries about leveraged investments and leveraged annuities. So at Provident, when a client asks like, "Oh, can I leverage up my investments?" And typically you would tell the client like, it's not really necessary. So what is our take on leveraged investments or leveraging up your investments?
Well, leverage is a tool. I mean, and so all tools have to be used for the right purpose. I guess it's for investing in things like stocks and bonds. We generally would advise the client to avoid leverage unless they, absolutely can handle the risk. Because while on paper the returns look great if you leverage, what most models fail to show you is sort of the emotional impact of getting a margin call. Because if it all just keeps going up, that's great. But then once the value of your investment falls, if you're under some kind of leverage, then you would have to top up with a margin call, and that can detract from your, I guess, ability to meet your future life goals. So in terms of being able to reach your life goals comfortably, at Provident, we think of it, or we recommend to clients that they should try and adjust their expectations so that they do not need to really take on leverage to achieve their financial goals. So that, in the event of any market downturn or fall in asset prices, they can hold their investments without the stress of having to deal with margin calls.
Right, I believe there was a study done by Yale University that says like if you are young, you can take 2x leverage and just stick to it. If you get margin call, you get wiped out, the next day you just invest again. And empirically, you can show like, oh, in the end when you reach retirement, you're likely to have a lot more money than other people. But behaviorally, that is a bit crazy, right? Imagine like you've been investing for a few years, you get wiped out, and to have the stomach to start again, the next day is a bit crazy. So a lot of people, when they are doing an analysis, they fail to realize the human aspect of investing. So at Provident, we believe that tilting towards certain factors such as smaller size companies and value stocks will give a higher expected return in the long run. So why don't we have a portfolio that goes all into small cap value? So let's say I have a long runway, like let's say 20 years, and I want to get the most I can for my retirement. So wouldn't it make sense to go all into small cap value since it's empirically sound and there's a lot of academic research about it?
Yeah, that's a great question. Well, I think, Isaac, you can have such a portfolio. 100% small cap value. You have the time frame and you understand the risks involved, working closely with all of us at Provident. But yes, I guess why we don't do that is because while it does give you the best return over time, the volatility of that return is extremely high, as you would expect, because you're talking about value stocks that are priced cheaper because the companies might not be doing as well in the current business environment, or you would have small caps, which are also always highly volatile because of the much larger uncertainty around their cash flow. If you take a big company like Apple, it's analyzed by every analyst all over the world. Anything that they do, within seconds. So there's a lot more certainty around what their future cash flow is going to be. So if there's certainty around the cash flow, you would expect that there's a lower risk involved, so lower expected return. While small caps, there's a lot of uncertainty around their cash flows. Not many people cover them, so you would expect the returns there be higher. But it can also, that uncertainty also means that there can be returns that are much lower sometimes. So that volatility would be extremely high. To give you an example, you would be running a standard deviation of probably maybe 25% if you were running that kind of portfolio.
Yeah, so as compared to, let's say, a market cap weighted index, so standard deviation of 25 for small cap value, what is a typical standard deviation for, let's say, a market cap index?
Yeah, I think you would be coming in at maybe somewhere between 16 to 20% for a large cap, index. But so you would be getting a lot more volatility. What that means is, in 1 year, if you would expect to get 12% return on small caps, this is just an example, throwing numbers out there, you would be 12% plus minus 25 or something like that. So you would have a huge variation in your returns, and that's not something that I think clients of Providend's profile can easily take, because the large part of capturing investment returns is about being able to stay invested in the portfolio long enough for you to get the returns.
Right, and most of the time they don't really need that kind of returns. I mean, based on the philosophy of sufficiency, most of the time, 100% equity and with a mix of bonds is enough for them lah.
Yeah. Yes. So that's the other part. So one part is you need to be invested to be able to capture the returns that you would get from the asset class. Then the other part would be recommending something to a client that is suitable. Like, do they really need this high return? Because yes, as you mentioned, a lot of clients that come to Providend generally are more focused on wealth preservation, and they are not looking to invest or to work with Providend to achieve the highest return possible, because they are coming to us to plan out their life goals and their wealth plans. So putting our clients into something that is much more volatile does not necessarily mean it's suitable for them.
Okay, so let's move on to this huge debate in the investing space: active versus passive. Right. So according to the Spiva study, which is a long-term study comparing actively managed funds and passive index, over a 10-year period, more than 90% of actively managed funds in the US underperform the index. So how do we think about this debate?
I think we can just see from the data that it's very hard to be consistent when you are running an actively managed strategy. So there are managers out there that do it fairly consistently, but you would have to firstly pick the right managers. And then the second thing about managers that run active strategies consistently and do it well is their fees are typically higher, because if you think about it, from an economic standpoint, the scarce resource is the manager, right? Their skill in being able to actively manage this portfolio and beat the market consistently. So you would be, if the resource is scarce, the price you pay for the resource would be higher. So you would definitely be expecting slightly higher fees on the active side. So at Providend, we try to be more consistent in terms of how we get our returns for the client, and so we prefer to just be more on the passive or index side, so that we can take away this added layer of uncertainty around having to ensure that the managers that we work with are consistently delivering better than market returns, because that's the reason why you would want to go with an active manager. You want higher than market returns. But if you are comfortable with the market returns, then going with a passive strategy can be more suitable.
Okay, so let me put you on the spot here. So Dimensional is one of the fund managers that we use. And Dimensional, they are actually active managers, right? So based on what you shared, we are leaning towards the more passive side. But why do we invest into Dimensional funds in that case?
That's a very good question. We use Dimensional because even though they are active, the way they invest is they don't do forecasting, and they are running a very systematic strategy. And so you can have active managers that run a systematic strategy that does not involve forecasting. Then at least the returns or the results can be consistent. When we know, Dimensional, they run a strategy that systematically tilts towards value stocks and small cap stocks. That means they, despite whatever the news is out there or whatever the world is doing, their strategy will always buy slightly more value stocks and small cap stocks based on their the criteria that they define these stocks, which they do, of course, explain to clients and investors. So being able to understand that the managers moving in a systematic way, their results are very consistent and more predictable. If you see value stocks do badly, you can easily expect that Dimensional will not do better than the market. If you see value stocks do well, then you expect that Dimensional strategies would do better than the market, which they do. So that's the reason why we are comfortable using them, even though they are an active strategy.
So moving on to diversification, and more specifically global diversification. So many people believe that investing in US equities via an S&P 500 index or a US total market index would provide enough diversification. So barring the past year, US equities have been significantly outperforming global equities for over a decade, or rather a decade. One of the most common arguments is that US companies already receive a large part of their revenues from companies all over the world. I mean, we have Apple stores in Singapore, we have McDonald's everywhere. So why do we still globally diversify our portfolios in that case?
Well, simply the answer is we globally diversify because we are not certain that the US stocks will always be the best performing stocks in every single period of time. And so when you globally diversify, you can at least ensure that whichever stock market, whichever stocks are doing better in any period of time, you're going to have exposure to that. And for example, right now, we see emerging markets outperform US stocks, and even European stocks are generally more favored right now by investors compared to US stocks because valuations are just much higher in the US right now. So if we weren't globally diversified, we might not be in the better performing parts of the market right now. If you just go back a decade prior to the last decade, in the 2000s, emerging markets were doing extremely well, and US stocks were, the S&P 500 was flat for I think 7 or 8 years. So not every period will be good for each country. So being diversified lets you ensures that you have exposure to the best performing stocks of any period.
Right, so that will lead to more reliable returns in that case. So if, let's say, we make a bet on a certain country, and of course if it does well, we'll definitely get a lot higher returns. But in terms of investing for a certain goal, we want the most reliable return. So not necessarily the highest return. So would global diversification help in getting a more reliable return in that case?
Yeah, you bring out a good point. I guess you can say we're not active managers at Provident. We're not chopping and changing our portfolios every few months to try and capture the latest trend or the latest macro call. We we also don't really have that kind of capability to do so effectively. So we tailor our strategy to make sure that the return is consistent. And so, yes, being globally diversified helps you get a consistent return because you will be owning the best performing stocks of any time period. Like, just for example, you don't even need to look at global diversification. Just saw recently that 90% of this year's S&P 500 return, that means January to end March, is due to 20 stocks in the S&P 500. So if you're not diversified, if you were picking one stocks or two stocks here and there and you missed out on these, you would be losing a lot of return. Of course, if you got it right, if you could have a crystal ball and just pick those 20 stocks, you would look like a genius. Yeah. But yeah, you would. How often, how consistently can you do that? So to make sure that we are going to be owning those 20 stocks no matter what, we are diversified so that the clients will get a consistent return.
Right. Okay. So that's all for this week's episode. Thank you so much again, Chai-Sen.
Thanks, Isaac.
So to all our listeners, I hope you enjoyed our discussion on Providend's investment philosophy. If you like this episode, please follow our podcast and follow us on social media for similar content. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.